Alice, how do I get a bigger tax refund this year and pay less tax to the CRA? If you're new here, my name is Alice and I am a chartered professional accountant. And in this video, I'm going to explain step by step what you can do to reduce your taxes owed and get a refund from the CRA. So let's start by explaining how the Canadian tax system works. Let's say that you make $60K a year and you live in BC. As an employee, every paycheck you are deducted CPP, EI, provincial and federal tax. And all of these rates are set by the government and they change every year. So your employer takes this money every 2 weeks and they send it directly to the CRA. Every time you get paid, the CRA gets paid. And then at the end of the year, your employer will issue you a T4 slip to add up all of these numbers. The Canadian tax system is based on progressive tax. Does making more money equal more tax? Yes, it does. But you're never going to pay extra tax on your existing income if you go up in a tax bracket. Every incremental dollar that you make is taxed at a higher rate. So if you make $60K, you may notice that you are in this 20.5% tax bracket. Does that mean your taxes owed is $60,000 times 20.5% equals $12,300? That is the biggest misconception that people have about taxes. It is a progressive tax system, meaning that every dollar you make from $1 to $57,735 is taxed at 15%. Only the portion from $57,736 to $60K, which is $22,664, is taxed at 20%. Your tax liability for an entire calendar year, let's say for 2024, is calculated based on your taxable income mathematically. So let's go back to the person with $60,000 of income. This person owes $58.21 in federal tax, $24.29 in provincial tax, $33.61 in CPP, and $8.94 in EI. This person's total tax liability is $12,596, and their effective tax rate is total taxes paid over their income, which is 21%. So going back to the beginning of this video, how are we going to get a tax refund? There are two scenarios that would trigger a tax refund. The first is if your employer over remits and sends too much money to the CRA. So if they sent the CRA too much federal tax, provincial tax, CPP, and EI, more than what you actually owe, that would trigger a refund. The second scenario is if you reduce your taxable income, that will immediately trigger a tax refund. We're also going to talk about the concept of tax deferral later on in this video, which does not trigger an immediate refund, but it does help you save on taxes. How to avoid unexpected taxes owing. So the reason why you might have unexpected taxes owing at the end of the year is, for whatever reason, you did not remit any tax during the year. This commonly happens with people that are self-employed, or you had a one-off transaction, like you sold real estate or property that's not a principal residence, or you disposed of securities that are not in a taxable account. It's very unlikely that you would have a random unexpected taxes owing as an employee, unless your employer completely screwed up, which is highly unlikely. So the main way that we can get a tax refund in cash, which is a direct deposit to your account after you file your taxes, is to buy RRSPs. So let's say you make $60,000 and you contribute $10,000 to your RRSP. At $60,000, you are paying $12,695 in taxes. If you contribute $10,000 to your RRSP, your taxable income is now $50,000, which means that you only need to pay $9,609 in taxes. Therefore, you will get an immediate tax refund of the difference, which is $3,089. The second way is to contribute to your spouse's RRSP. So if you make $120,000, you are paying $31,000 in taxes, which is an effective tax rate of 26%. If you contribute $20,000 to your spouse's RRSP, you are eligible for the tax deduction. So your taxable income is now $100,000, and that reduces your taxes owing down to $24,773, which gives you a refund of $65.64. And that again is for contributing to your spouse's RRSP. Now let's say your spouse makes $40,000. They pay $69.48 at a 17% effective tax rate. The benefit of contributing to your spouse's RRSP is that they can pull out that $20,000 contribution at the lowest tax bracket. Let's say your spouse withdraws this income and they continue to make $40,000 a year. Well, now they have $60,000 a year because they have to add that $20,000 onto their tax return, and they pay $12,596. So you got a refund of $6,564 for making that contribution to your spouse's RRSP, but on withdrawal, your spouse is only paying tax at $56.48. And that, ladies and gentlemen, is how we save on tax with spousal RRSP contributions. The third way we can get a tax refund is through contributing to your FHSA account. Example, you make $75K. You contribute 20 grand to your FHSA. Your taxable income in that year is $55,000. Let's say that the $20,000 investment grows to $25,000 in 5 years. That $25,000 can be pulled out entirely tax-free if you use that money to purchase a home, and it's considered a qualifying withdrawal. If you use that money for anything other than purchasing a home, that $5,000 gain will be added to your taxable income. Let's talk about tax deferral strategies. The first is to contribute to a TFSA account. Example, you make $60,000. You contribute $10,000 to your TFSA. Your taxable income is still going to be $60,000 for the year. So you don't get a tax refund, but if your investment of that $10,000 grows to $12,000, that $2,000 gain, you will never pay tax on, even if you pull out all of the money out of your account. This also applies to RESPs as well. Example, you make $75,000. You contribute $5,000 to your kid's RESP. Your taxable income at the end of the year is still $75,000. This $5,000 grows on a tax-deferred basis. So let's say that this $5,000 becomes $12,000 once your kid is 18. This amount is then taxable to your kid when they go to college or university. Only the investment income, not the original contribution. So only the $7,000 is taxable to your kid. Usually when kids go to college or university, they don't have a ton of income anyways. So this is also a good tax deferral strategy. Now we talked about tax deferral as well as tax refund, and let's talk about reducing your taxes owed. So the main way that we can cut down on our taxes owed is through non-refundable tax credits. They're called non-refundable for a reason because they don't trigger a tax refund, but they can reduce your taxes owed down to zero, just not more than that. So here are the main non-refundable tax credits. If you make political or charitable donations, you can claim these. A federal political contribution can be claimed by either spouse. The caveat is that one receipt cannot be split between spouses, so you have to pick, and it's usually going to be the higher income spouse. Charitable donations can either be cash or in kind, as long as they are donated to an eligible charity, and they should give you a tax receipt if they are. Other things to keep receipts for include medical expenses. So if they're eligible expenses and your income is high enough, you can deduct medical expenses. You can claim medical expenses after they exceed a certain amount, which is either 3% of your net income or 28.34, which is the prescribed rate, whichever is lower. So for example, if your net income on your tax return is $40K, you can deduct expenses that exceed 3% of that, so $1,200. If your actual medical expenses were $3,000, you can claim $1,800 times 15%, so $270 in medical tax credits to reduce your taxes owed. Childcare expenses. So if you hire an eligible childcare provider like a daycare or an au pair nanny, the lower income spouse can deduct these childcare expenses. If you send your kids to private school, that's not considered an eligible expense because that is academic and it's not considered care. The maximums for claiming childcare expenses are $8K for kids under 7, $5K for kids between 7 and 16, and $5K for kids over 16. Moving expenses. So if you move for school or work and you're at least 40 kilometers closer to your new location, you can deduct all of the meal and travel expenses related to the move. And there's two ways you can claim these expenses, either by tracking your receipts or using the CRA prescribed rate calculations. Here's a list of all the other non-refundable tax credits that you can claim. Now, if you self-file, the filing software will usually ask you a list of yes or no questions. These are personal profile questions. that you answer, and the system will automatically determine whether you're eligible for that credit or not. You don't really have to worry about these too much on a line-by-line basis. So for example, if you put your birth date into the software and you're over 65, the tax software is going to automatically calculate the age amount for you. You don't have to worry about checking it off or clicking in a certain box. So basic personal is a non-refundable tax credit that all Canadians can claim. The base amount in 2025 is $12,392. So anyone generating an income at or below that amount will basically pay nothing in tax, and anyone generating more than that will get a partial reduction on their taxes. Age amount you can claim if you're over the age of 65. Caregiver amount, so if you provide in-home care who has a physical or mental impairment, you may be eligible. Disability amount, if you have a disability and a medical practitioner certifies the effect of your impairment, you can be eligible for this credit. CPP contribution, so if you're employed or self-employed and you pay CPP, this will be eligible to you, as well as if you're a business owner paying yourself a salary. EI premiums, if you're employed, this will be applicable to you. If you're a business owner that's EI exempt, this will not apply to you. Canadian employment amount is as its name. If you are employed, this will apply to you. Pension amount, if you receive a pension in Canada, this will also apply to you. Investment income. So how do we cut back on our taxes paid for investment income? So if you have taxable investment accounts, you can typically claim investment fees that are charged on those accounts. So let's say you have 100 grand in a taxable investment account that's generating 10K in interest income or dividend income a year. Let's say your financial advisor charged you $1,000 or about 1% of your total investment. You can reduce your investment income down to $9,000. Now, this is not going to give you a tax refund, but it is going to help you save on taxes because mathematically it's really small portion of any investment income that you make when it comes to the fees owed. Rental income. So if you own an apartment that's not your principal residence and you rent it out, so let's say you rent out a place for $2,000 a month, so you have to add $24,000 a year to your taxable income as rental income. What can we do to reduce the taxes owed associated with this 24K? So mortgage interest. Any interest that you pay on your mortgage for that property is deductible against the rental income. So you can also deduct CCA. So let's say that you buy $10,000 of brand new appliances to upgrade the rental property. You can deduct that in expenses, but the CRA requires you to do it over a period of time. So you cannot deduct that 10K entirely in the year that you purchase it because it's considered capital in nature, but you can split up that expense over a few years to deduct. Now, let's say you buy a new washing machine and that washing machine breaks down and you have to pay $1,000 for a handyman to come fix it. That $1,000 is considered a repair, which means that it's deductible in the year that you incur the expense entirely. Now, when it comes to your home, this is something that all Canadians get, and that is the disposition of your principal residence is tax-free. If you own more than one property, you can elect which one is your principal residence so long as you lived there for a period of time. And for tax planning purposes, we generally want to elect the one that has the highest gain per year of ownership than the one that has lower gain per year of ownership. Principal residence exemption is not going to give anyone a tax refund, but it is still something that's available to anyone. If you like this video today, hit the like button, subscribe to the channel. Let me know what questions you have about Canadian taxes. I posted another video a while back on all of the important tax changes to be aware of for Canadians for 2025. So make sure you check out that video up top here, and I'll see you guys in the next video. Until next time.